Oil prices rose as much as 8% on Friday.
Oil markets are reacting to escalating warfare in the Middle East.
If this conflict stretches out any longer, you might see coming bottlenecks in the industry.
MarketBeat's Gabriel Ossorio Massili shares a list of 3 oil stocks that are already positioned for stronger growth.
Over the past month is already up double digits. That's not even accounting for what just happened over the weekends.
How retail investors can prepare for the oil impact of this rising conflict. Let's dive in. Gabriel, so great to have you back on the channel. Today we're talking about a major geopolitical issue having a big impact on the stock market. The Israeli bombing of Iran heading into the weekend has really had a major impact on oil prices. Talk about what the oil market was doing Friday.
Yeah, this is an unfortunate event, obviously, but it has impacted the stock market, oil markets, and pretty much everything else over the weekend going into this event. So oil reacted as anyone would expect on a geopolitical conflict like this one. Oil prices rose as much as 8% on Friday and then hovered around 6 to 8% to end the day. So of course that has a lot of implications down the line when it comes to costs, input costs, transportation costs that are obviously going to affect a lot of industries, not only in the Middle East, in Asia, Europe, but especially in the United States. And I think that's where investors need to start focusing on today.
Yeah, clearly there's a lot of uncertainties with this incident that just happened. There's going to be a global reaction potential, but we know Iran is such a major player in the oil industry that this industry just makes sense is going to see a continued impact, not just in the short term, but likely more of a long-term impact. Talk about kind of what investors should prepare for heading into the summer season with this conflict news.
Yeah, you're absolutely right. There's two sides to the equation right now. And you already mentioned that Iran is one of the leading producers of oil, and one of the biggest buyers of that oil is China, right? But then you also have the Strait of Hormuz, where a lot of oil goes around the world and it's a strategic point of transportation. So if this conflict stretches out any longer, you might see coming bottlenecks in the industry, and that obviously is going to affect oil prices further. Now, another factor to keep in mind is supply. Around the world, we have low cyclical supply levels that, maybe with the tariff war and everything else happening in the economy, like the slowing down of China, slowing inflation in the US, maybe some countries figured out, okay, we might not need as much oil moving forward, so let's just draw down our inventories and not produce as much. And obviously that leaves a weak spot open for bottlenecks to start forming up if anything like what happened over the weekend starts happening. And obviously if it stretches out, then it's going to get a lot worse than that it is today. So I think that investors should start to make a game plan to profit from the rising oil prices in the right way. Staying with the most probable outcomes, staying with the best setups, and also finding some diversification moving forward.
I know you have a list for us today of 3 oil stocks really set to soar this summer. And this was even before this incident. There's already some indicators, like you said, many other factors impacting this oil sector before this incident. But now that it's here, this list is even more relevant today. So let's just dive right in to the first company on your list of oil stocks that are really set for a strong summer ahead.
Well, obviously, when there's uncertainty and you don't really know what's going to happen in the landscape, you want to seek diversification. And this is why I didn't pick one stock to start with. I picked a whole ETF. And the most weight in this ETF is made up of the large cap producers like Chevron, Exxon, Hess, Shell, etc. Right? So the reason I want to start with that before we get into the more high risk, high reward side of the equation is because when oil rises, all of these companies are going to see their earnings per share increase down 3, 6, even 9 months, right? Because it takes a longer time to refine the oil, produce it, and then deliver it to customers that are willing to buy it at that price. So earnings are going to come. Higher valuations are going to come. There's no doubt about it. It's going to take longer, and that also gives investors time to slowly buy in and mitigate some of the volatility that's happening today. But there's one factor right now that can confirm all of that, and it's the US just pulled the most inventory out of the supply since December. Now you have this unfortunate event happening in the Middle East that acts as another bottleneck, and then also you have the potential of inflation coming back up according to consumer estimates and expectations moving forward. So if you combine the factors, right, you have low supply of oil, it's cyclically low right now. Then you have the bottlenecks being formed potentially in Iran and the Strait of Hormuz. And then you have the summer season that's all about traveling and spending. And, you know, of course, you have the inflation expectations. Then it all makes sense to start looking at that diversified ETF, which is the ticker symbol XLE, that carries some of the bigger names that are more diversified. They have international operations as well. So you're kind of mitigating those risks outside of the United States and lining yourself up with a global renewed interest on oil, right? So I think that's where investors should start to look in. Again, they'll have more time to scale in a position. They'll have less volatility along the way, and they'll be lending on the right side of the equation this time.
Now, whenever you mention an ETF that has names like Chevron and Shell in there, as a consumer, you start to think, oh no, does this mean higher gas prices at the pump? But taking away that perspective as a consumer out there, for investors, let's take a look at what this is meaning for the price of this ETF. Have we already seen a boost in this chart?
Well, we've seen it underperform a little bit compared to the S&P, especially after the Liberation Day, which is when President Trump announced the new round of tariffs, right? And the reason is there's a lot of uncertainty as far as new orders coming in from businesses as they have to now figure out the cost to bring in new products to fulfill those orders. So of course that uncertainty has affected the retail sector, the industrial sector, the manufacturing sector, and even tech. So when that uncertainty hits, of course there's going to be less demand for oil, as businesses don't know yet whether they're going to have to increase production to fulfill orders, to transport those new products, and so on, right? So it's all a trickle-down effect. But on the shorter term, you're going to see that rotation outside of more speculative names like technology and maybe some consumer names, and then back into energy, because that happens every cycle, right? You have a slowdown of inflation, and then it hits a bottom. The government has to act. There's going to be some added uncertainties as well from the tariff side, from the geopolitical side. So I think that the energy sector and this XLE ETF gives investors a great risk to reward ratio as things stand today in the world.
All right, so that first pick is a more safe choice, looking at the ETF kind of covering the sector as a whole. What's the next stock on your list of oil companies that have a really strong summer ahead?
Well, this one would be for those investors who have a little bit less time or even a little bit less patience, right? That would be Transocean stock. And the reason I picked this one is because it's at the higher end of the value chain. So let's go back a little bit, right? I mentioned that the higher producers, the large cap companies, they'll take about 3, 6, even 9 months to see the profits coming down the line from higher oil prices because of the manufacturing process, yada, yada, right? But when you go to the top of the value chain, that's where the driller names are, where the drilling equipment leasers are, where they get paid first, essentially. And that is where Transocean stock comes into play. These contracts, right, for leases on drilling equipment are directly tied to the price of oil. So what happens is the following. When oil prices go up, Transocean is going to be able to make more contracts at a higher rate once these companies realize, okay, we have to get going, bottlenecks are forming, oil prices are too high right now, we have to come in and increase the supply, right? So even before that happens, they have to go to a company like Transocean to get the right amount of equipment, to get the right capacity before they even undertake this process. So I think that when you're looking to get paid first, of course, with higher volatility, I think Transocean could be a stock that comes into play.
Very interesting that this is one that's going to see more of an immediate impact than some of those larger oil companies that won't see the impact down the road, like you said. Let's take a look at what this chart has been doing and what analysts are saying too.
Well, Transocean stock is an interesting story, right? This is a $2.8 to $3 billion company. So of course the percentage moves are going to be a lot higher, a lot more varied than that XLE ETF that we gave as a safer play. So over the past month, it's already up double digits. And that's not even accounting for what just happened over the weekend. So I guess that when the market realizes that oil prices might stay above $70 a barrel for longer, I think the earnings expectations are going to not only increase on the part of Wall Street analysts, but also the stock price, right? So again, with no news, no price action, oil staying at the low 60s to mid 60s per barrel, this stock still delivered double-digit upside. So just imagine what could happen to this company once the effects of higher oil start to affect the large producers, and then those have to look into a company like Transocean to get the right capacity ahead of production increases. So the benefit of having a company like Transocean is that it's so small. It's so easy for this one to go from 2.8 to 5 billion, right, on market cap. It's not that easy for a company like Chevron to go from a multi-hundred billion market cap and double in size. So I think this is where the risk to reward starts to get a bit wider, right? So investors might expect a lot of volatility in exchange for a higher payout. So I think this is a nice play. This could be a nice, tremendous play moving forward if prices stay above 70 to 75 a barrel.
Really good point that there is such a tremendous growth opportunity here. But as you said, just as much as it could double, I think there is the risk involved in some of these smaller companies too. Talk about that. What investors should be prepared for on the risk side with a smaller play like this?
Well, on the risk side, they should look at the chart itself and get a narrative behind it, right? So on the business side, we could talk about how if oil starts to come down, then of course the cash flows and the earnings and the revenue potential are going to get decimated. Let's be honest, this company relies heavily on those contracts. And those contracts, as I said, are tied directly to the price of oil. So if you believe that oil is going to break down below the 70s and go back into that previous range of mid 60s, low 60s, forget about Transocean. But in the world where oil is going to get higher and higher, I think that Transocean should be an obvious play here. Now, let's go back to the chart, right? That part of the equation tells me that compared to 52-week highs, this stock has priced in most of the worst case scenarios today. So let's just look at things as a chessboard game, right? You have a potential to go down maybe 10%, 20% on the stock, but then what's the upside? The upside points to maybe $5, $6, even $7 a share. And that's not even the all-time high. That's not even a fraction of the all-time high of the stock. So I think that room, as far as the ceiling goes, it's a lot higher than the potential bottom that we could see in the stock. So it's a high risk, high reward play. But I think it's worth it in a world where you think that oil is going to keep going higher.
Yeah, very interesting pick for investors to consider on this one. Let's get to that third company on your list of oil companies to watch this summer.
Well, this one would be Helmerich & Payne, right? And the business model is the same as Transocean. The reason I picked this one as a worthy mention is because Transocean has a bigger distribution network. It's a little bit bigger in market cap, and it's gotten a lot more attention from Wall Street, from analysts, and potentially investors down the line. But I think that if Transocean goes and FOMO kicks in, right, then I think that investors will start looking down the line or spread out their views when it comes to the drilling sector. So I think that by association, Helmerich & Payne could also see further gains down the line, especially keep in mind that the business model is the same. So if Transocean starts to get a lot of capacity utilized, right? So by that I mean a lot of customers come in all at once for Transocean, prices are going to go higher for those contracts. So these competitors are going to see a benefit, right? If Transocean starts to raise their prices, then these large producers, these large oil players might have to start looking at Transocean's competitors, and that's where Helmerich & Payne comes into play.
It's interesting to pick two companies that are very much so competitors. Do you expect to see both of them rise kind of together, or could one take off far more than another based on that competitive edge?
Well, for that, I would need a crystal ball, right? I think that you could look at Chevron and Exxon and then ask the same question. It's not really clear, right? It's about popularity. It's about who gets the most attention in the short term, which is why I picked both, because we really have no idea whether these customers are going to go first to Transocean or first to Hallmark and Payne. The fact that I do know is these are the two leading players when it comes to drilling equipment and leasing. So this way you could diversify the bet, saying, okay, maybe Transocean goes in first because they have the larger market cap, they have more capacity on hand, more responsiveness, but then maybe those pricing dynamics might send people into Hallmark and Payne first because pricing power is in the hands of Transocean, so they might get a better deal on Hamburg. So you would have to have a crystal ball, like I said, to know which one goes first, which is why I mentioned both. Maybe this way investors can spread out their bets and then let time do its thing, right? See which one gets contracts first, gets more attention first, and then let the price do its thing after all.
Yeah, good idea to put both on your watch list and maybe spread that out a little bit because they're such similar companies. If you want to add both to your watch list, you can sign up for our free SMS alert system. If you're in the US, you just have to text YouTube to 68285 to sign up for free price action alerts on these stocks or any stocks on your watch list. For both of them and even the larger ETF pick that you mentioned, I think it's important to finish this out with a conversation about how long it could be before we see a really big impact in the stock price if this Israeli-Iran conflict continues to be a larger story and continues to raise oil prices. How long could it take before we see a real impact in the stock price of the companies you just mentioned?
So to answer that question, I would go back to the level of supply that we have right now, which we know historically we're sitting at low cyclical levels. Now, the next part of the answer should be based on whether the conflict stretches out or not. So, as I said, the Strait of Hormuz is a very, very important strategic point that, if affected, is going to heavily affect China because China imports 96% of its oil from that place alone. So, what happens if China sees its oil costs go up suddenly? Then the manufacturing costs go up, transportation costs go up. That could affect the United States as well, Europe as well, and pretty much all countries that deal with China. So you have the tariff risk, you have the oil risk as well. How long does it take to see the profit? Well, the Massili ETF, remembering that markets are forward looking, and profits might come down the line in the next 6 or even 9 months, I think that the next quarter could see a great advantage as far as guidance goes from the larger companies in that ETF. So maybe Chevron CEO or Exxon CEO comes in and says, okay, we're seeing the geopolitical risk, we're seeing the bottlenecks, and we expect further guidance to be above our estimates, right? That could be one catalyst. Now, as far as the drilling names go, like Hallmark and Payne and then Transocean, that could be a lot faster. That could be a news headline that comes in, or a quick reaction as far as institutional buying comes in. As far as the timetable, next quarter. I would say next quarter is a sensible timeline, it's a reasonable expectation to see this play out, especially keeping in mind that markets are forward looking. So if they start to expect those factors to come into play, then of course they'll start paying prices today to reflect tomorrow's expectations.
Yeah, it's a really good discussion on what is happening in the oil market right now and how these stocks might be impacted. Thanks for sharing this list with us and diving into this market a little more. I want to hear from viewers. What do you think about this attack in the Middle East and the impact it might have on the oil industry? Do you think it's time to start gearing up for an investment in this sector, expecting prices to go up in the future? I'd love to hear your thoughts in the comments. Thanks for watching, everyone, and as always, happy investing.